Were we right all along? The Federal Reserve just introduced a steep drop in the interest rates last week, and it has lended weight to the idea that even Jerome Powell might be anticipating a recession. Jim Rickards has been saying this for quite a few months, which is why his analysis on this 50 basis point drop by the Feds gives so much food for thought. This is not financial advice, but subscribe to the channel and watch what he had to say before we delve into it. And by the way, I met my parents during Hurricane Helene, so forgive the new background. Let's go.
I'm going to bring in Jim Rickards now, talk a little bit about the greatest stimulus to buying gold, I think, right now. The Fed rate cut of 50 basis points, quite unexpected. Jim, what's your take on this, and tell us what you do so we use your 5 minutes well here.
Sure. Peter, I like to do this kind of analysis by comparing narrative to the reality. So the narrative is basically a made-up story. It could come from Wall Street or Washington. The reality is based on hard data and will actually play out. The reality always wins in the long run, but in the short run, the narrative can win. So here's the narrative. The narrative is the Federal Reserve cut interest rates 50 basis points, 0.5% on Wednesday. This is supposed to provide stimulus. People borrow more, spend more. The stock market went up a little bit, et cetera. So it's all good. It's also a compliment to the Fed in the sense that they've engineered a soft landing. By the way, there's no such thing as a soft landing. You can keep flying, you can crash hard, but we don't have soft landings. But they've engineered a soft landing. Wall Street also calls it the Goldilocks narrative. Not too cold, not too hot, but just right. Okay, so that's the narrative. Here's the reality. The Fed has hit the panic button. They've been doing 25 basis points, 1%, up or down for a very long period of time. To go 50 when you pivot, when you go from rate hikes to rate cuts, to do 50 all at once, basically exposes the fact that they're behind the curve.
I think there's one key word from what Jim Rickards just said, which is stimulus. A rapid lowering of the interest rates creates a buzz in the market as people and corporations rush to get access to cheap credit, which in turn speeds up spending, production, and the economy at large. But the first question is, why is that needed in the first place, and why such a drastic drop rather than the soft landing we had been hearing about for months? Here's the truth. You can view the U.S. economy in two broad segments. One is a small bracket of people and businesses that spend and produce as large companies. They're like the whales in the water who are much harder to move with something like an interest rate change, but also cause a lot of splash when they do. But the second segment is made up of the vast majority of the rest of us running small businesses and spending as individuals or small family units on their important needs. These are people that are the engine of the U.S. economy. Small businesses constitute 2/3 of employment growth and nearly half of the country's GDP. When credit gets cheaper for them, their buying power increases further. That's like a knob on the inflation control for the central bank, as well as the chief way of maneuvering out of a recession. And if you look at most of the last 20 years, the Federal Reserve has lowered interest rates at a relatively slower pace, at around 25 basis points, which is 0.25%, 0.25% at a time. That's why Jim Rickards calling it a panic button sounds so true, because it could very well be a hidden sign of what the Fed is expecting in the coming months.
The chairman of the Fed had a long press conference, and reporters actually did a decent job of asking him, well, because he said the economy's solid, the labor market is solid, everything's normalizing, it's all good, in other words. And they're like, well, if it's all good, why are you cutting 50 basis points? And he said, well, we want to keep it that way. That's the narrative. The reality is the economy is slowing very rapidly. There are a lot of technical indicators, but the price of oil has gone from in the past year from $90 a barrel to about $69 a barrel. People say, that's good, lower gas prices at the pump. Well, it's not good if you don't have a job, if unemployment's going up. By the way, it's going down for the wrong reasons. This is demand-driven. People are driving less. They want less, and plenty of supply. That's not even an issue.
Now, that may sound paradoxical to you. If the price of oil is going down, that should be a good sign, right? Well, not necessarily. There could be a supply side lowering of prices, which means there's more production of oil and more efficient supply chains. But that's not what's happening right now. Oil prices are falling because the international market, particularly the US, is just not consuming the amount it should be. People are becoming more conservative in their spending as their purchasing power was taken away during the last 2 years of recession, and while it has certainly bounced back after the sharp dip during the pandemic, it is still far from the level it was before 2020. High oil prices in the last few years have impacted every sector, since all logistics and supply chains also naturally depend on oil and transportation. But that's just the beginning, because the kind of recession that Jim Rickards is talking about here is on a much broader scale, driven by factors that the United States government or the Federal Reserve simply cannot control.
Let me ask you a question now. Is your forecast for recession or inflation or both?
Recession with a disinflation, possible deflation. Now, in the long run, we're going to have inflation because that's the only way out of the debt problem. But in the short run, we're looking at inflation to come down a lot, which is disinflation, maybe even deflation, definitely recession. We're either in one or you can see it on the horizon. And it's going to catch a lot of people by surprise. And it's bad for the economy, but it's good for the Trump campaign because the U.S. economy is bigger than anything. You can talk about, they're all important issues, taxes, border, tariffs, all important issues. But the U.S. economy as a whole is, first of all, slowing down. Secondly, heading into recession. Again, the oil price decline is a sign of that. People look at all these things. The Fed doesn't drive the economy. They follow the economy. Interest rates were already coming down a lot. They're still coming down. It's called a flattening yield curve. It's going to be positively sloped. But why are interest rates coming down? Because the big money in the markets know that the economy is going to hit a recession, and rates are coming down. So you want to lock in higher yields right now. And by the way, Peter, you're absolutely right about gold. Gold hit an all-time high intraday on Wednesday afternoon when the Fed cut rates. It was up around 26.60, which is an all-time high. It's still, kind of in that range, 26.40 this morning, but it's very bullish for gold and bearish for the economy, unfortunately.
Now remember, it may strike you as odd that Jim is predicting a recession with such certainty, but if you speak to economists, they will tell you that economic slowdown and recession are actually part of an economic cycle. The only problem happens when some vital miscalculations happen or international factors amplify the economic slowdown out of control. What usually happens is economies buzz with production and consumption until some external or internal event causes consumption to slow down. That leads to overproduced goods that are not being absorbed into the market. It can also happen when a period of rapid inflation like the one that we've seen after 2020 erodes the purchasing power of people, eventually leading to a slowdown on the consumption side. And we're seeing a mix of the two right now. Combine this with what's happening in the treasury bill market with an inverting yield curve, and you start to realize how a lot of these factors and signs are converging on the prediction of a recession. Obviously, you're never going to hear the Federal Reserve come out and say it because they can't. We saw that when a reporter asked Jerome Powell a question of why interest rates had been lowered so fast. Jerome basically turned the question into a reassurance that it was all okay and the American economy is solid and robust, but for anyone with a deeper understanding, it was easy to read between the lines.
Do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind.
We certainly stand on some very uncertain grounds, especially since the lack of knowledge around this is deliberate to make sure it doesn't set off hysteria or panic. But zoom out into the bigger picture and it becomes clear that the last 4 years of inflation is cooling down to the point that a period of recession might set in. Let me know in the comments if you agree with Jim Rickards' assessment of this, because we're not going to find out for ourselves until the next few months.